91% of the value expiring is calls. Across the S&P, same thing. 91% of the value, single stocks, massive 78% is calls. So everybody's on one side of the boat, and all the value that is expiring here next Friday, right, is piled into calls. And I often think that this is an extremely good indication of a very overbought market. Call skews are at the highest they've been in the last year. The fact that all of these positions are at the top of the screen is highest call skews in the last year. What does that mean? That means the value of an out-of-the-money call is higher than has been essentially since almost the entirety of the last year. What's the probability of something going wrong? I don't know, but the price to bet on something going wrong right now is as low as it gets.
So, Brent, I think you've come up with a perfect title this week, which is Big, Beautiful, and Overbought, because that probably explains a lot about what's been going on right now.
Yeah. I've never had a conversation with you about crypto before, but I had in my mind that if you had owned a lot of crypto, you just wouldn't show up to this call. So based on the fact that you're here, I'm guessing that you're not all net worth in Bitcoin.
I'm one of the few people, I don't know if it's one of the few people, but one of the people who's never owned crypto in any way.
That's kind of a value guy that kind of makes sense, I guess.
So one time Justin gave me one ETH, is that the right way to say it? One ETH, like a long time ago, because he wanted to show me the power of it. And of course, it was like when there was a huge drawdown in ETH. Yeah. And I'm like, this thing's going to zero. And then I just like liquidated the thing, the one ETH, and like now it's worth, I don't even know what it's worth, but I'm basically the one person with like significant negative alpha in the crypto space.
Oh, that's funny. Well, it's good. I'm glad you're here. I wish you could have retired on crypto riches and moved to Puerto Rico or whatever they do. But
it would have been nice. I mean, maybe YouTube channel riches someday, but it's just, based on what we've done so far, seems unlikely.
This one might be the banger that you've been waiting for. You never know.
This is it, right? This is what changes everything.
I'll try to say something inappropriate that gets people's attention.
But what's been interesting is, we continue to have, and especially a little bit more recently, but we continue to have some degree of negative news, and we continue to have, the grind higher. It's not like we have the ridiculous, market surging every single day with outrageous call buying, although we're going to find out a little bit. There is some call buying going on.
It's getting outrageous.
It's interesting.
Yeah.
It's just interesting. Like, this is just like the slow grind higher.
It really is. And I think, I'm hesitating because no one's here for Brent's macro thoughts, but the big, beautiful bill just seemed to sort of suggest more of the same and sort of this inflation kind of thing, and Trump's trying to get rates down and he's pumping the market, and so you just kind of ride the bull, I guess. You know what I mean?
Yeah. No, I mean, momentum obviously in my world is a big factor, and momentum right now is just cranking.
Momentum is the factor, levered ETFs and all that other stuff. So here we are. I don't want to fight it. That's for sure.
To see, nobody wants my macro take either, but what we're basically giving people takes they don't want. What will be interesting to see is, we are starting to see now some of maybe the negative tariff news coming back out. So some of this, like, we're not going to be able to get a deal with this country, or this tariff rate is back to where it was on the, the big board you put out. So it does seem we're starting to see the drip of this negative news, and it'll be interesting to see if that eventually reflects itself in the market.
Yeah. I think what you're trying to say is taco, and that is the theme that everyone is living by. So kind of like the boy who cried wolf, maybe one day he'll be like, no, this is for real, and I'm going to give you some tariffs. But for the moment, it all just seems to be, people just get tired of it, I think.
One framework someone gave me that I think is really good on this is, and again, I don't do day-to-day stuff, but this idea that when the market's at all-time highs, Trump's going to get aggressive. Like, you're going to start seeing tariffs and all this other stuff. When it's down a lot, it's not going to be aggressive. And so that's not a political opinion. That's just kind of like the way the market has been playing out, is like the market at all-time highs gives some leniency to maybe do some of this stuff. And then if we go back down on it, then we're going to maybe back off some of it.
I think it makes sense. Charlie McGilligan of Nomura says the same thing. Like, there's a Trump sells calls because the market's at all-time highs, so you could sell that call, which is use that as leverage. He's one of the only people selling calls now. I'll just put that out there. So
I just listen to him a lot, so I'm probably regurgitating Charlie McGilligan.
It's good, smart guy to regurgitate. It's nice. I like to hope that Charlie McGilligan reads some of what I'm writing, so it's kind of like goes from me to Charlie McGilligan into your ear, and then you talk back to me.
Right. It's a vicious cycle, but
I'm giving myself entirely too much credit. But one day.
But anyway, as we get into options here, this is going to be an interesting one to look at. This is not a huge expiration like we saw in June for the quarterly expiration, but the market's been up. As we'll see in a little bit, people have been buying calls. It's an interesting one to analyze as we think about what's happening going forward.
Yeah, so if we pop forward a few slides here, we can start to get into those hedge to the size of the options expiration. We always like to pause quickly, just while adding that one of the reasons that we watch the options flow so much is because obviously, and we've talked about this a lot, options volumes are exploding. They continue to get larger and bigger, and that's exceeding stock volumes. And so you hear this from a lot, like people like McGilligan, that options are the tail wagging the dog. I think in that Odd Lots podcast you just mentioned, he said options are just the dog. And so when these options volumes pick up, the idea is that all of these trades are happening and market makers have to hedge, and they do so with the underlying stock. Now we can get into this, but we should note that we just launched a new episode of how to delta hedge, right? And so, Jack, I don't know if you want to segue
That's
real
right.
quick.
Yeah. So we have a new show on excess returns. Teach me like I'm five. And we have 3 episodes, and the third one we just came out 2 days before this was all of this stuff. We talked about dealer flows. We talked about Vanna, Gamma, and Charm. We defined it. We tried to take it at a high level of, if you don't know a lot about this, here's the step-by-step, guide to teaching this stuff. So I would highly recommend, we'll go through this in all these presentations because on YouTube, people watch stuff and don't watch other stuff. But I would highly recommend, first of all, you don't stop this video so that my watch time and my stats stay really good. But second of all, when you're done with this video, that you head over there and watch that, because it's a great primer Brent provided on all of this.
Yeah, and the rub here is simply that when everyone's buying calls, those calls go to market makers who are 90% of the options volume, and that can add up to be a substantial amount of stock that has to be bought or sold, as you can see in our example here. And the thing is that once you hedge with that initial share count, you have to adjust those shares as the underlying price changes, that's gamma, or as time passes, that will be this charm kind of concept, or if implied vol moves, and we're going to talk about that a lot here today, and that's that Vanna concept. So there's always this dynamic hedging influence in the markets, and that's what we're really trying to watch here and talk about those impacts into this July expiration.
Yeah, and this is the OPEX cycle here, which is so important because this is kind of a big turning point in some of these flows potentially. And positions build up, and then they maybe change as the options expiration clears.
That's right. So the cycle is the options positions build up, and then as those positions build, the hedges build up, and then expiration, all those positions go away. And so that is why these OPEX cycles are so important, why they could be turning points. There's a million red X's on this chart. Each one of these represent an options expiration going all the way back to 2018. We've covered in depth, key turning points like in the COVID crash. But just look at the last few expirations, right? You had June here, which was a low in the market. Before that, we had May, where we had a real short turn, right? We had a brief correction there. You can go back to April, February of this year. If you look at the February market high was to the day. We sold off right after February expiration. So they've been real turning points here over the last couple of months. And I think this is no different. I mean, you see how extended we are into this July expiration. You could just see how nice it would be to put a little red X right there and then see a brief correction.
And we would expect, because this is not a quarterly expiration, would we expect this to be less impactful or not?
Yeah, so if I just pop forward a couple of slides here, the single stock delta. So the delta, we pay attention to that because you could think of delta in this terms of what is the stock equivalent that's set to expire. And so in this case, you can see here that this is a pretty large expiration. It's almost as big as September expiration. And if you look at the notional values, we're about half of what June was. And June was the biggest options expiration ever because it's a quarterly expiration. And the thing that you take away from this is that this is so extremely call weighted. We talked about in May how call weighted things were and how I thought that was going to lead to a turning point. This is even more extreme than the May expiration. And what you can read here is that what is the value of calls that are set to expire versus puts? And you could see here across NASDAQ, for example, and Russell, 91% of the value expiring is calls. Across the S&P, same thing. 91% of the value, single stocks, massive 78% is calls. So everybody's on one side of the boat, and all of the value that is expiring here next Friday, right, is piled into calls. And I often think that this is an extremely good indication of a very overbought market and a great time for a brief correction, right? And this plays into a bunch of events that we're going to talk about as well.
Going back to the cycle, I think it's time for me to go into the mailbag here because we got a couple comments on our expiration video, and I wanted to ask about it because one of the things people say all the time is, well, we've had these, we've had these expirations. We've had no turning points. The market just keeps going up and up.
Yeah.
Like, why were there not turning points? And I think, and I'll tackle it first, and then you'll probably tackle it a lot better than me. But number one is I think it's really important with anything in investing to think about the world in a form of probabilities. So there's never going to be an options expiration where there's a 100% chance the market's going to turn. And, all the other stuff we do too, like I'm a long-term value investor. There's never going to be a 100% chance in any given year that value is going to work. And actually there's been a 100% chance it's not going to work in many of the years recently. So first of all, I think it's very important to think about like anything you talk about in investing from the perspective of probabilities. I don't know if you agree with that.
Yeah, no, absolutely. And the other thing is that I think that people have to understand that my time frame is pretty short, right? I have a max time frame of 30 days out, and so much of the options volumes now are concentrated in very short durations. And so a lot of the times when we go in and to your point, I remember in May, because I think about this a lot. I go, May, hey, this is overbought, and we're gonna talk about the June corrections, why we go back and we talk about what we forecast and how that played out. But you think about like May, right? And May was very overbought, and we got a 2-3% correction. Which, if you're a long-term holder like yourself and you just didn't pay attention to that, well, the market continued to go up, in a month later, right? But for a lot of the people in my environment who are short-term, swing traders, have shorter-term views, that 2 or 3% is a lot of P&L, right? That's swinging, and you see that kind of overbought condition wear off, right? And I also think that in the terminology that I use, and I say overbought, that's kind of a different take than this thing's about to get just pummeled, right? And I think that there are different effects, right, that you can see. And there are certainly times that there are these historic bottoms that come in with options expirations, right? And so, every expiration or every month there's an expiration, and the impact of that sometimes is going to be more subtle, right, than a longer term kind of quarterly expiration at an all-time low kind of thing, right? So everything needs a little bit of context, behind it. But what I look here just to preface this is that we're at 6250-ish, right, near all-time highs right now. And I think that moving back into the 6,000 area by visiting that by the time we hit August is totally reasonable, right? And who knows what happens with tariffs and all that sort of stuff. And the Fed, there's a lot of news events in between that. But we're in this overbought condition. And so how you want to tactically trade against that, if you're a value investor, is do you want to sell some calls here, right? Do you want to add a few hedges? Do I think the market's going to go down 50% here because there's an OPEX? No. Is it a good time for a correction? Yes. And idiosyncratically, too, when you look at individual stocks, we can see also different things playing out. Like if you look at a CoreWeave, for example, it's getting pummeled, right? It's down quite a bit, 10, 20% or whatever it is over the last week. And this expiration is going to clear out a lot of that pressure, right? So there's a lot of also that individual stock value. But, to the point, May, we had a very brief correction. We're going to talk about June here shortly. And in July, just be very clear what I'm looking at. I think a 2-3% correction, and then there's some path dependency to how some of these macro events play out. But quite frankly, it just feels like dips will continue to get bought, right? But this overbought condition has to wear off.
That was what I was going to say too, and it furthers your point, which is this idea that there's like a capital T turning point and like a lowercase t turning point. And for people like me, the capital T turning points are going to be much more relevant.
Yeah.
Like the little blip on the last expirations, I'm a long-term investor, maybe if I was like trying to get into a position or something, I'd say, let's wait a little bit here and I get a little better price, but it's not a big deal. But for the big T, like obviously the COVID type stuff is a much bigger deal. And there are some different things you see, right, in these expirations that might give you an indication of whether this might be a capital T or might be a lowercase t.
Yeah. And next week we have CPI, for example, right? And VIX expiration is the next day on Wednesday, and calls are extremely overbought. So you have an overbought condition. Puts are cheap right now. We'll talk about this shortly. But what if CPI is a tail print, right, and it's extra hot? Market could get absolutely slammed on that, right? What if CPI is just a non-event? Well, we'll kind of like try to drift a little bit. But the point is that the fuel to sort of pump the market right now has largely been pulled out, right? And so that rate of change should be slower, and the support is weaker now, right? Because the calls are so overbought and puts are so cheap and there's not a lot of put positioning. So if we're given the catalyst, then you have a lot more downside risk in this market versus a market that maybe doesn't have expiration for another few weeks.
And is the idea that fuel, if that fuel is going to get taken away, but if nothing happens and time keeps passing, that fuel will build back up as we head towards the next expiration?
That's exactly right. And since no one is in puts right now and no one is expecting downside or position for downside. In fact, they're positioned for the complete opposite. They're positioned for more upside in this market. Calls are expensive. And you would argue that when these calls get expensive, the expected payout of buying calls right now has to just decline substantially, right? And if there is a shock and there is demand all of a sudden for hedging at these all-time highs, well, then you could have a pretty significant correction, right? So that support underneath is not super strong. Do I see people trying to push into that and get into long volatility trades, and things are so out of whack right now that this is like a July 24, July 2024 scenario? Not quite. But at the same time, and I just brought this slide up here because we showed this, I think it was in the May expiration, where, these stats show that volatility changes around these expirations, right? And like I said before, there's an expiration every month. So sometimes the impact can be really large. And sometimes, like you said, it's a lowercase t in terms of impact. But statistically, these do prove to be turning points. And obviously, if you have a 20-year time horizon, then this probably doesn't matter all that much to you. But if you're looking at shorter term time horizons, then I think this is a significant. This is significant. This data and information is significant.
So the idea here is if realized volatility is low going into an expiration, the end result after it is different than
It
when you
tends
look
to
at all
flip.
cases.
Exactly. So it tends to flip. So in this case, you look at the delta into. This is the change of realized vol into an expiration. That's what we're referring to as delta. Delta is the change. So realized vol in these low vol environments tends to kind of crunch, and then when we have expiration, that volatility tends to expand, right? And so when you have low realized volatility, which is what we have right now, volatility tends to expand after expiration because we're removing these positions, right? And if you look at it the opposite way, if you say, hey, what happens if IV is spiking, right? If the VIX is at like 50 when we go into expiration, well, realized vol tends to shrink after expiration, right? So the signal flips, right? High vol to low vol or low vol to high vol, and that's been statistically shown. Sorry, tongue twister there. So these are data backed inferences that we're pulling out here.
Before we get into the current stuff, I just want to go back one slide, and because this gets at this probability idea
Yeah.
that I was talking about before, which is the percentage chance that you'll get a flip at expiration, and that depends on whether VIX expiration is before as well.
Yeah, and look, let's say that you are a manager and you want to dole out some new cash right now, or you've been looking to build a position or whatever it may be. And I'm sitting here saying to you, Jack, calls are extremely expensive right now, particularly like the spiders. And, we have these overbought conditions that are just showing up in the volatility data, right? It's not Brent and his macro hot takes. I'm looking at volatility values and positioning and all that sort of stuff. And so you go, okay, I'm going to wait till after expiration, and you're able to buy in 2 to 3% lower. If you're doing that consistently, that's a lot of alpha, and I think can really boost returns over time. So, and as the options volumes grow and become more impactful, I think that you can really get some edge and squeeze out again some extra alpha by playing these probabilities, right?
When is VIX expiration this time?
It is on Wednesday, so it's before the options expiration.
Okay.
Yeah, so the probabilities change a little bit, but the key here is that you often hear this term window of weakness, right? And what that essentially historically has meant is when the market's very strong and volatility is pretty low and you get into VIX expiration kind of marks the start of that window of weakness, right? And that window of weakness goes through essentially the Friday OPEX, which is the equity OPEX. So there's a little bit of a performance flip depending on which one comes first. But generally speaking, 2/3 of the time you see the performance flip, which means if the market's strong into OPEX, it's a 2/3 chance we get a correction after, right? Or vice versa.
So on this next slide, gamma and projected volatility, we've been sliding slowly to the right here. It seems like every episode we do.
Yeah, that's right. And if you look at where we are here, where I gotta update that one. I apologize, I didn't move my arrow. We're somewhere up in this 1.5 area. So what this essentially means is how much gamma is there in the S&P 500. And if I give you the gamma reading at 8 in the morning, it has a forecast probability to how much volatility or how much movement we have in the S&P in the following session, right? So it's kind of a 1 day forward look. And the deal is, the more positive gamma we have, the more kind of call positions are in the S&P, the tighter volatility is, right? So there's less risk in that type of a market. And then when you get down towards the left here in these put-heavy environments, you tend to have a lot more volatility, right? Ranges are larger, and that's on a forward 1 day basis. So gamma as a short-term prediction has a short-term predictive ability, I would say.
In these lower volatility, higher gamma areas, we expect some of that to clear at the expiration. And so we
100%.
expect the opportunity at least for expanded volatility.
That's exactly right. And that's why these can be turning points. And I think that's why it explains or syncs with the idea that volatility, right? Realized volatility, or how much the market moves, changes around these windows.
So you went over this July OPEX a little bit already,
very.
but do you have any other major takeaways from this?
It's just very call heavy. It's not as big as June. So, again, this is the lowercase t impact that you had mentioned before, but it's very, very call heavy and suggests that, we're really quite stretched. And if you look at, sorry, Jack, go ahead.
Is there anything in like single stocks relative to index or anything unique about this, or is this pretty rather than
Yeah, we're gonna go. We'll cover those couple towards the end.
Okay.
The extreme call values are really what's interesting. We have some slides on correlations, some things. We'll get to that very important point. But here you can zoom in on these expirations a little bit. So here's May OPEX. You could see that we had that nice kind of correction, 2-3% correction. June expiration, things were getting a little squirrely, and then the Monday after, we had Trump solve the Iranian situation allegedly. So market just ripped off of that, and we haven't looked back. But you can see that there is a lot of synchronicity with these expirations and turning points. And look, in Feb, that was one of them, right? I mean, clear as day. You can't you can't dispute that as a turning point, and that was the window to a pretty big correction, right? So sometimes these are more impactful than other times. So let's go just take a quick look back at S&P vol, and the theme in there was the market had no real worries into that June expiration, right? S&P implied vol at 11% is down near the areas of, as low as it gets. And that essentially means that markets just aren't pricing in any risk. And that was kind of the theme of the no worries situation. Realized vol was at 11. That green number is kind of what we watch in the options market as a standard. That's 1 month realized S&P vol or historical vol at 11%. That's, pretty low in terms of historical standards, right? And right now we're a little bit below that. So the market wasn't moving much. The market wasn't pricing in much volatility. We had big breakouts in semis, right? And so we were just kind of pushing aside the geopolitical risk, pushing aside the tariff risk, and can't argue that's that tone has really changed at all. Correlations seemed like they were increasing into the war, which was a big thing with the Iran situation. We had gold and silver kind of breaking out. That Bitcoin we flagged as these assets that were kind of moving, breaking out a little bit, and equities were very highly correlated, meaning they were moving in conjunction with each other. And so the argument there with the Iran kind of backdrop was, do I own stocks in this environment? Do I own gold or Bitcoin as another asset? Oil was really going crazy at that time, really catching that bid. So people were really, in my view, into June, still selecting, like, do I own equities as an asset class? Do I own bonds? Do I own crypto, right? Or gold, right? So these things change, right? And we're going to talk about correlation here shortly, where everybody knows they need to own equities right now, and it becomes, which equity do I own? So we'll touch on this in a moment as kind of a risk signal.
I'm just curious on the Israel-Iran thing. Like for someone who's not inside of the day-to-day stuff, like it was surprising to me, and they talked about this on our Click Beta show as well. Like the reaction was so muted when that whole thing happened in the market. Like, did you see anything in options that was it very muted there as well in terms of what you would have expected?
Yeah, I think when you look at the way that all this went down was, people had some concerns about when the U.S. actually dropped the bomb and got involved, right? There was a little bit of a vol spike around that event. But then we very quickly came out and said, we're going to get some peace, and the market was getting kind of chippy when we got involved. And then that was the Monday after June expiration. And then Trump comes out and is like, we're all done here. Iran's agreed to a peace plan, right? And so all of a sudden that vol just cleared out. It was just bam, gone. And then the forward window for tariffs was not for, kept getting tacoed or punted or whatever. And so people just said, okay, risk on here, right? And then you got the big, beautiful bill, which is, I think everybody would just agree that seems like it's inflationary. There's no cost cutting in there. And, here we are. We're just kind of pumping again, right? So we had this sort of like artificial vol, I would say, because of the geopolitical risk. And then that geopolitical risk just got cleared out and allowed for a pump to take place. So it was that was pretty interesting.
Yeah, that makes sense. I'm so curious because I never see, I'm like the value guy here at a high level. I never see the behind the scenes stuff.
Yeah, and so one of the things that we talked about a lot in June was the dealers were short upside calls, and that's what in this yellow box. And again, these are all slides from the June presentation. And the idea was that if the market started to rally, there were dealers short calls that would have to start buying stock. And then you slam vol or VIX drops after the Iran situation. And so when you're sitting here going, how can we be at all-time highs so quickly and because of tariffs, Well, dealers had to chase, right? And that's exactly what this showed. And, so did I know the market was going to rally, move higher because Iran was going to have a peace deal? No. But if you're going to tell me that the market, we're going to clear out the peace situation, the market's going to rally, then I would, and I believe we really went through this in June, say this thing can rally more than you'd expect because of that positioning, right? So there are these, if-then statements. Well, if you're going to tell me how much the market's going to rally, I could probably tell you how much. I don't know if it will, but if you're going to tell me it's happening, then you got to watch out. And if you look at where this thing dips, right, this negative gamma dips, it's right at the 6,300 level. So, the positioning was there to support this really big rally, and I think that the rally, is not all that surprising if you look at it through this options lens. Again, once you cleared out some of the market risks, the sharpness of the rally is not terribly surprising.
Yeah, it's like the fuel was sitting there; it was waiting to be lit, and then certain circumstances caused it to be lit.
That's 100% right. So, I don't want everyone to sit here and think, oh, Brent was saying the market's gonna, rally off of a macro view or anything. It's just sort of like, look, you give me a reason to rally, a la Iran Israel thing goes away, tariffs got punted, whatever else would be, big beautiful bill, it can rally a lot, right, because of this positioning.
Yeah, it's always interesting to me, like the way people, options traders, think and this conditional type stuff, and I think that's sort of important in a lot of different things in investing because none of us know exactly what's going to happen in the future. You almost have to have this if then, as you said before, like if this happens, this might happen because of the way things are positioned. But if this happens, things could change completely. Obviously, neither you or I are going to predict wars and things like that.
Yeah, and everything is about probabilities, really. The options market all day long is giving you a price for a probability. This call costs a dollar, or the implied vol of S&P calls are 10% or something. And if I think that's wrong, then I should buy those calls, right? If I think they're underpricing the probability of a rally. And so oftentimes in the option space, for example, like recently, one of the more successful trades has been betting on implied volatility, or excuse me, betting on the fact that the market's going to move more on a one-day basis than what the market price is in. So, for example, you just buy what's called a straddle. You buy the at-the-money call, at-the-money put, and the market's been moving enough to make that straddle pay off. So you can have these situations where a lot of times what the options market boils down to is a bet on volatility, right? Do I think the market's going to move more or less? Do I think stocks are going to move more or less than what the market's pricing? And that's kind of the basis for a lot of the trading here. And to that point, right now the market's pricing in very little movement, and that to me is what the opportunity is as we look through to August.
That's interesting. I don't want to go on too much of a tangent, but this is when you're tweeting all the time, here's the price of the one-day straddle. That's what you're looking at, and you're looking at that relative to sort of what it's been priced over time to tell you, does that look cheap or does that look expensive?
That's exactly right. And we talk in implied vol terms. We cover this in the actually dealer hedging video because implied volatility allows us to compare timeframes. So if I quoted the straddle, for example, I tell you the straddle, 0DT straddle is right now trading at a 15% implied vol. You can go, oh, well, what was it trading at, 2 years ago? And it was trading at a 20 implied vol. You could say, oh, it seems cheaper now. And that would be fair. But if I quoted that in dollar terms, well, the S&P, today is at 6,300. 2 years ago is at whatever, 4,000, right? So the premium value of that option would be totally different, and you couldn't compare them. So when we talk in implied vol terms, we can compare them, and then there's the rule of 16, which is if you divide implied vol by 16, you get an estimated one-day move. So that's also helpful. But the reason we quote the straddle is because if you tell me that this is the most important CPI that you've ever seen, right, and the straddle's trading at the 0DTE or the market estimated move for today is trading at a low of the last 2 years, I'm going to go actually the options market is telling me that the CPI doesn't matter, right? But if the CPI is trading at, 50 implied vol for the day and the market is pricing in a 3% intraday move, well, then this is probably the most important CPI I've ever seen, right? So you can glean a lot of information from that. And I think it's important in this day and age of, social media, newscasts, and a lot of people have a big audience and maybe they don't fully understand what they're talking about. There's a lot of hyperbole out there and all that stuff. And so you can look at that options pricing as data-driven, right, forecast of what the market thinks is going to happen. And
It's interesting because, because you can say, you see on CNBC all the time, like people like market on edge because of X, Y, or Z.
Yeah.
You have a way to say, is the market actually on edge because of X, Y, or Z by what people are actually doing, not what they're saying.
100% right. And there's plenty of times where I go, the market's pricing in no movement like right now, and I'm willing to bet that there's going to be movement, and we'll talk about that in a minute. Or there's times where the market's pricing in some absurd move, and you just go, odds are that's not going to happen, right? because what are the odds of a 5% move into CPI day, right? Nothing. So am I willing to sell that, right? Am I willing to sell those options because they're expensive? You look at like Bitcoin options, we're going to talk about this in a minute, right? Where you get FOMO, people are chasing, right? And they drive those options prices up. And when they drive those options prices up, you need bigger and bigger stock moves to sustain these values, right? And that all comes down to probability. So, Jack, if you're buying a Bitcoin option right now, betting on sustained 10% moves, I'm probably going to be like, I disagree with you, so I'll sell you that call, right? Whereas right now, no one's betting on S&P downside. Puts are extremely cheap. So if you sell a put right now, you're basically, if you're wrong, right, it only would take like a 1% move down in the S&P for all put holders. If you sold a put short and we get a 1% move, all those people got to cover, right? So what happens when they cover? If you're short puts and you cover, that adds dealer pressure to the downside. So these options prices, right, and the positioning around them can also influence behavior. I'll state that a little more cleanly. If the market's pricing in no movement and we start to get some movement, that creates what we call jump risk, because suddenly you have to go, I wasn't expecting anything. Now we're getting something. Shoot, I got to cover, right? And I got to go from a short put to a long put. What does that mean? That means I'm buying puts. So dealers are short puts and there's stock has to get sold. I know it's a mouthful. You would think I have about 75 cups of coffee today, but I just got that options lingo adrenaline pumping through me. So hopefully you're able to.
No, it's great. And I will say, by the way, on your Bitcoin call thing, if you ever see me buying Bitcoin, it's going to be the top. So you should sell those calls all day. You should be telling me like, I'm going to get in line and I'm going to be the one selling you those calls if you ever decide to buy them.
Yeah, that's noted. And based on the way that you said ETH, I know you're
yeah. I don't even know what it's called. Like
Ethereum.
Yeah, definitely true.
And in the June, so out of the June OPEX, we were really focused on the JP Morgan call, and I know we're kind of belaboring the what happened in June. And my core view was I think we're going to touch 5,900 because of this positioning, and we did have these calls to the upside. And if you kind of look at what happened here, I put the little tilde. We got 5,940 the Monday after expiration, right? And right here is where Trump announced the peace deal. So, huge rally after that, as you can see here, market, just up bigly, I think is the term for that. And so, what was the view incorrect? I don't know. You could be kind of the judge of that. We certainly were testing that JP Morgan position on that Monday after expiration, but after that, we just absolutely kind of ripped. And again, those short calls to the upside, I think, really kind of helped to forecast the idea that we could rally more than people were expecting.
So as we get into July here, what better way to start than with a White House tweet?
Yes. So I've said a lot. If you're still with us here, I have some forecasts here, and I think generally speaking, when I talk, we aren't. At least me personally, I'm generally not offering. I try to offer a two-sided view. I'll put it that way. I have a one-sided view here. So all the comments and negative emails you can send them to Jack, and he will parse through them.
I'll flash my email up on the screen just so
I'm very fragile, so I don't know if I can help them. But if I were to give you one image, Jack, and you would tell me whether this is bullish or bearish, this was an actual tweet from the White House yesterday. Panicins, they call them, hardest hit. And this is a meme. If you're listening to this, and most of you are watching on YouTube, this is a meme of an angry bear, I guess, looking out his window, and there's this green chart going up, and then he closes his curtains. And so Trump is pumping this thing, pumping the market. He's really excited about that. And so, generally speaking, it's odd to have the White House posting memes about stocks going up. But he's enjoying these all-time highs and these crypto pumps and everything sort of else. And so this is the backdrop. If you're going to talk about the meme of what's happening, you remember, like Jensen Huang signing the woman's top, right? And it took,
I do remember
a minute,
yes.
But that was that led to a really nasty, I could tie that to the VIX 65 that happened in August, right? Now the stock has recovered, I think, and maybe has taken out those highs. I haven't looked recently, but you see these kind of memes that just summarize where we're at. And this is the meme. And in this case, you missed your Bitcoin ETH allocation, so you're annoyed.
Are we at the point, Brent, where we have to throw out the data and basically it's like Jensen Huang signing and like tweets and stuff? These will be the new market indicators that will guide us in the future.
Yeah, it's kind of like the Matrix, I guess. There, and that we all live in a simulation. It's probably not appropriate to talk about. If you're interested in something that makes you feel like you literally live in the Matrix, look up the Matrix. The guys who wrote the Matrix movie. and you'll feel like you're in a simulation. Anyways, enough of that. What's going on now? Vol's getting wrecked. And so what this is S&P term structure. And this past week, we saw an 8% in the S&P implied vols for short-dated vols. That's as low as you get. You have to go to 2017, interestingly, to see lower implied vols. So vol can only go to 0. And even then, it's like crazy to think it would get anywhere near that. So we are at the lower bounds in terms of implied vols, full stop. And what's interesting to me about this is that you could see for next week, the vols are really low here, Jack. And then at 8-1, you see the volatility term structure seems to have an increase, right? Do you know what's so important about 8-1?
That is a new tariff date, isn't it?
That's right. I don't know if that's Taco Tuesday. It would be really great if it was. But that's where we're alleged to get these new tariffs. And so the fact that there's this kink in the vol curve is telling us that the market actually does care about this. So I'm making fun of it, but the market does care about this. But there's a whole bunch of stuff happening in this red zone where this really low implied vols are, right? And we're going to talk about that in a second. But the market is pricing CPI next week, FOMC on the 30th, as essentially they're risk-free, which I think is really, quite interesting. So that's the situation right now. Market's pricing in literally no risk. And then take aside from that the fact that we have VIX expiration, options expiration, where 99% of people don't pay attention to that stuff. Obviously, I do, and I think that could be a turning point for vol. So that's a reason for vol to move up. You go back to the stats. What tends to happen when we have a low vol regime into options expiration? Volatility tends to increase, right? So we have all these things, and then I want to add this on, right? This is what's called our compass tool. And so I've plotted all of the different XL ETFs, right? So XLV, XLF, everyone here is probably familiar with those. And everything is in the top left of this grid. What does that mean? This is telling us that call skews are at the highest they've been in the last year. The fact that all of these positions are at the top of the screen is highest call skews in the last year. What does that mean? That means the value of an out-of-the-money call is higher than has been essentially since almost the entirety of the last year. And there's been some major rallies. July of last year is still in this time frame, and how bullish that was, right? When Nvidia was just going, ape, right, every day. And with that, we see implied volatilities overall are fairly low. So people are piled into calls. They're very comfortable with the situation. And, when you just look at this statistically and you say to yourself, this seems like a very crowded trade, right? That's what this is telling me. If you remember in April, for example, everybody was in puts. So you would have seen, if we looked up put skew, we've all been piled into puts. And so if you think again about the probability of pricing, we just rallied, 5 to 10% in a lot of these different equities, and everybody's positioned for more upside. So these calls have gotten relatively very expensive. They don't really, you need even more upside to get these to pay off, right? And so, what's the upside at this point to help us through? That would be up for debate. But generally speaking, buying calls at record high call prices doesn't tend to pay off.
So this is telling us that people are buying more out of the money calls relative to in the money calls?
Specifically, these are 1 month, what we call 25 delta calls. So these are slightly out of the money. I would call them attainable prices. So if you think about in something like an XLF, 2%, 3% rally, something like that, you're not talking about needing a 10% rally for a lot of these to pay off. And, here's Bitcoin, right? And this was taken this morning. So this is before today open. So the vol is probably even higher. The call skew is higher. You got XLB, the Dow, the communications XLC, which is a lot of Google is in that, Qs. All this stuff is just saying people are positioned long calls, or at least that's what dealers are defending, or they're positioned like they're short calls is what this is also showing us. So, you can't bring yourself really to buy calls in this situation. Maybe if you're going to do a stock replacement, you'd say, okay. But just the fact that these are expensive calls, I personally I can't buy calls because they're too expensive, right? It just doesn't make any sense.
And just going back to the vol smash thing, I said one other question. Did you see any reaction at all in terms of what happened this week? I mean, I think there was like a copper tariff. We just did Canada yesterday. Did anybody care about any of that so far?
No. And this is live market data from this morning. We had a brief market move lower on Monday. But we played right into huge options positions, and the VIX this past week hit 15 and change, which is the lowest it's been since February. So it's funny to me that people are hanging on this August 1st tariff thing, because Trump's sending out letters. No one cares. Everyone today is like, what about the EU letters? Like, nobody cares. And if they do care, they're not worried about today. They're probably, they're anchored maybe to have it being a problem for August 1st. And maybe that's really what this is like, okay, the tariff stuff is August 1st and later's problem. So I can kind of like party on for the rest of July, which I think is incorrect. But I think that's kind of what the positioning is. Because let's face it, right? If you're trading for today's options and 60% of SPX volume is 0 DTE, what does a letter mean to you? Great, a letter got mailed out. That doesn't change what's going on for me today, right? That's not affecting what happens between now and 4 o'clock.
What's interesting to me on August 1st too is this idea that when you throw something completely unexpected at the market, like the way it reacts versus when it's had time to digest. So I'm wondering, like, so if you think about the original Liberation Day, like what he put up on that chart, nobody saw that coming.
It's a very good
And
point.
so the market went nuts. And I would assume tariffs is going to be, if there's huge tariffs again, it's going to be a negative for the market. But also the market's had a ton of time to like think this through. So the market has probably a better feel for what the actual negatives are in terms of how it translates through to the value of companies now than before in terms of its reaction. I don't know if that makes any sense, but I was just thinking about that.
You're 100% right. When the market knows it, right, and when it's priced in, like it's priced in. So that sounds like a ridiculous statement, but that's kind of what the truth is, right? Unless you get the thing that no one was watching, right, that the totally unexpected, then the market's just going to generally react by keep on doing what it's doing. And so if you look at this now, it's like today Trump tweets about this, but then he gives concessions on this thing and concessions on that thing, and it's 40% for you, then it changed. So it's like everybody's basically positioned for some rhetoric, and ultimately we're just kind of go on with life. And how much is this stuff going to be impactful? Everyone's used to it, right? I mean, you think about the tweets that were happening in April. He would tweet something and the market would go 5% in a minute, right? It would just be crazy. But now it's all kind of been normalized. And so you bring up a really great point. And if anything, we've now pushed it too far, right? Where I think it's like, okay, now everyone's just totally ignoring everything to too much of an extent. I know I'm beating that theme with it to death.
And that's not to say like if August 1st there's tons of tariffs, that's not going to be bad for the market. I would just think it's less likely to cause some massive VIX spike or something because the market's kind of seen what he wants to do on tariffs. And if he does it again, it's not like some crazy unexpected event.
Yeah. And, so what would cause like a lot of consternation would be, a hot CPI report, like a tail CPI report on Wednesday, right? That no one is, or Tuesday, the 15th, sorry, that no one's expecting, right? Or Powell comes across and is like unexpectedly hawkish, right? Because of something that he sees or whatever. And then you maybe get Trump fighting to get him out faster. You could play a bunch of different scenarios, right? That's against the consensus scenario. You have earnings coming up, right? Prime Day was horrible. Market didn't care, but maybe you get some other data that says, hey, consumer suddenly is struggling, right? And then Powell doesn't want to drop rates. So you can have these weird scenarios that play out over the next couple of weeks. And that's the point. What's the probability of something going wrong? I don't know, but the price to bet on something going wrong right now is as low as it gets. So am I willing to take that chance? Sure, right? If I had to pay an extremely high option price to bet on something going wrong, I may not do it because even if it's low odds, I don't want to overpay for something. So we had talked about correlation. We did this really extensive series in July, right? We talked about the number of freaky things that were happening in the markets, never seen before bullish movements. And you see that here in the record low correlation of July. Well, when correlation spikes, it gets back to the topic we were talking about back in June, which was everybody was in the either I own equities or I own oil or I own bonds, right? Trade that was spiking because of the Iran situation. It really spiked back in April because of the rate changes and the tariffs, right? It's like, do I own equities or do I own bonds or just go in cash? Like those are my decisions. And now what we're seeing as this correlation metric drops is that's a signal that people are now chasing single stocks. It's like, hey, I just have to be in equities, but what equities do I own, right? I got to own Coinbase because it's a Bitcoin thing. I got to own some AI name because whatever, right? We're not arguing, do I own NVIDIA or do I own bonds? It's like, no, which stock do I own? And that is a signal of correlation. Correlation drops when that happens. And when correlation drops like this, it's telling us that people are getting chasey, right? And so, we can hold these relative levels of correlation for a long time. If the tariffs turn out to be nothing and Powell's like, hey, I don't know, maybe we'll cut in a couple weeks, then the market's probably going to rally, right? I got no problem with that. But that doesn't solve the kind of like short-term overbought condition. So on a near-term basis, we're very overbought, but correlation could stay really low like it did for all of 2024 is kind of what I'm getting at. This rate of change maybe speaks again, in correlation maybe again speaks to this short-term overbought condition.
So in this next slide, we're getting into some of the potential reasons for worry, which we've covered a little bit before, but there's some new ones in here as well.
Yeah, and you have CPI, VIX options expiration on the 16th, OPEX on the 18th. Then you have FOMC. Then you have this tariff deadline. Charlie get again. This is the third time we've talked about Charlie. Charlie, if you're listening, man, give us a shout out. The buyback window goes out with the earnings. With the earnings window opening, right? And another point on this, just to be very clear, so that the options people listening to me are not throwing their shoe at the screen. When we go into earnings season, correlation generally drops anyways because people start placing earnings bets. So there's a little bit of extra oomph in that, just to be totally clear. But Charlie was mentioning that the buybacks are now one of the largest passive flows, and he said, I believe he said it was the largest passive flow, and I didn't realize it was the largest passive flow. So you're just losing another kind of like supportive flow, passive flow that comes into the market. It's just another reason for things to be a little bit chippy, right? And again, these are the list of things that could go, that could invoke some volatility or loosen positioning up. But the market is literally pricing in this window as basically meaning nothing, right? And so this is the area where I go, look, we've all chased calls up to extreme values. We're pricing in basically no movement for next week. And there are 5 or 6 catalysts, and I'm sure there's some random tweet or some other bond auction or something that I'm not including in here. So you got a whole bunch of things that could go wrong. So when I look at this and I go, okay, if any one of those things plus the OPEX positioning just shifts things a little bit, we could have a nice correction in this market. And I can bet on that very cheaply at this moment because put options are just, quite frankly, really cheap, right? And if you own a put that expires after the tariff window, right? That tariff window is keeping implied volatility elevated, right? It's supporting put values and implied volatility values, right? So the carry of the put right now to own a 1 month or 2 month put, just to hold it until FOMC is actually, I think, very cheap and very reasonable here, right? And so maybe we get a 1% correction and the puts pay off a little bit, or maybe we get a 2-3% correction, then you really get paid, right? So that's what to me is just screaming here in terms of opportunity. And so generally speaking, we're pretty one-sided, or I'm pretty one-sided in these things. But in this time, I think, selling calls to buy puts or call that a risk reversal or just buying outright puts are quite cheap here and cheap to carry and, could have a really nice payoff with just a little bit of downside movement.
And I will say Jack's bearish YouTube video indicator is starting to come off the highs a little bit. Like I think people, as you know, I analyze all kinds of YouTube channels to figure out like techniques that are working and stuff. And the bears are backing off just slightly. They're giving up a little bit. When they give up, obviously we're that's the bottom, that's the top basically, and it's over.
Yeah. So this is a fresh opportunity for you to put some more flames on the screen. Maybe only half screen of flames because I don't think the end of the world. But yeah, I think things are getting a little ripe. So to your point,
I've actually done the flames, and I probably never will actually do the flames because I just don't like to get involved with that. But I would like to talk about the potential that at some point I might do.
Oh, I'm excited about this headline. You've been really good with your headlines. So here is a few other assets. We were joking about crypto, and crypto took out highs in a major way. It's up, I believe it's 7% since Wednesday. So it's just really going bananas. And what does that mean? IBIT is the Bitcoin ETF. Calls are 90th, 95th percentile expense now. And so when I look at what's happening in Bitcoin, and they talk about the Genius bill, that's supposed to be announced next week. I don't know if that's a sell the news thing, but you're getting these places now where I don't know what the upside level is in Bitcoin. It's fresh highs, so maybe there's not some level that everyone's watching. But when you start to see the implied volatilities get really rich, you see this in gold in the past and in Chinese stocks in the past and in single stocks in the past, you start to get to this point where it's like, okay, the momentum has just got to collapse on itself because of the fact that these calls are getting so expensive. Calls can always get more expensive, right? So that's always the scare here. But you're really reaching into this territory now where the options are getting rich. The other thing that was going crazy was copper, and XLB has a lot of that. Has some copper, like Freeport is in there and some stuff like that. It's also now showing very high call prices. Copper is just going bananas. So again, this is a short-term overbought. 6 months from now, could copper and Bitcoin be higher? Sure. No idea. But in terms of this is getting rich right now, feels like it's very rich. And so what does that mean? If you want to overwrite some, I think that makes some sense. If you want to take a little off the table, try to buy it back, something like that makes sense. But you're just getting into these conditions where the options market's screaming like, okay, time to take a breath.
I hadn't been paying attention to copper, so it rallied a lot after the tariff announcement.
Yeah, it was up substantially. I haven't checked it recently, but you had kind of like a 5% one-day move and a real breakout, and Trump was talking about 50% tariffs in copper. And so, there's all these macro things happening that, look, I have no idea about the macro stuff. I just know we're getting super rich in terms of the option space. XLB is kind of this sleepy ETF. We're not talking about, AI, the leading cutting edge AI stuff. So, again, it's just getting over its skis in terms of what I see, but that's short-term views.
Well, as a value guy, Brent, I'm much happier to talk about copper than AI stuff. So I like that. We're talking about copper, steel, retailers in the ball that are struggling. Let's talk about that.
Jack, did you consider that AI needs that copper though? So those things are very related.
That is true. They're probably all interrelated.
For you value guys out there, is XLY Consumer Staples probably got a lot of value there, right?
Yeah, I'm sure.
Yeah. So those are
staples have been staples have rallied a lot. Our staples have been, trading at premiums sort of relative to what they otherwise would here at times. And what's interesting about staples too is you could really argue that the big tech firms are the staples of the current environment we live in. Like
they're the boring dividend stocks.
They've become effectively the staples.
Right. That's right. It's funny. I was listening to a Lynn Alden podcast. This is the consumer discretionary ETF. I know I had that wrong. I was listening to Lynn Alden on Macro Voices, and she was mentioning that a Microsoft and Apple are just kind of like the new safety trades, right? It's like everybody owns them. They're the defensive trade. They're kind of like, and I was like, that's actually really true. It's a pretty good point. And you see a lot of call overwriting in those names to supplement income, and that adds positive gamma, which makes them stickier. It's kind of funny. But anyways, your consumer discretionary basket, which is maybe more value than anything else, yes. Jack. Those calls are cheap. Definitely. Those calls are cheap. So you can head into that if you'd like.
I won't be heading into any calls, but
what's your beak? What your beak there?
I certainly own our quant portfolios. We certainly own a bunch of those.
And then last, we usually have levels, right? What we see here is if this curve gets higher, there's more positive gamma, right, in the market, and volatility should contract. So if you look at 6,300, this is a general area we're in right now, right? There's these positive bars, which is telling us that people have been selling calls into this general area, the 6,280, this kind of 6,300 area, and that really slows the market movement down, right? There is a very big position in at 6,500, so that's a forward level that I think we really want to watch. I don't think for August, but maybe for like September. But in the short term, there's a lot to digest here at the 6,300 level, and I don't see that changing. It doesn't seem to be changing with this expiration, and so I think this 6,300 level could be one that we're contending with for the next couple of weeks. Certainly before we get through, I think maybe FOMC and the 8-1 deal. But the bigger thing to me, which is weird, is that there's no downside levels, and this is our proprietary positioning. So we estimate where we see the buy side positioned, and we update that every day. There's no major bars to the downside at all, right? There's no big put positions down there to lean on. There's not a whole lot happening that I can be like, this is the area of support. The area that I would flag for purposes of this conversation is that 6,000 area, because it's that big round number thing. And, you can see there's some mild put positions there, but it's very weird to not see any downside positioning. And that to me speaks to this idea that no one's really in puts, right? No one's in downside. No one really cares at this moment. And so what would I look at as the support? Okay, let's get back in. It's very simple from my perspective. In the previous slide, we showed call prices, right? How rich are they? What this is showing us is if you're in the bottom right of this quadrant, what we're showing here is how expensive are calls relative to puts. Does that make sense? So we're looking at a 25 delta call versus a put. And right now, the calls are very expensive relative to puts for all single stocks. We're packed in this bottom right of this quadrant. What I would want to see for me to say, okay, let's get back in is I want to see all these names shift back to the center of this grid to show average call prices versus average put prices, right? Make them both average to each other. maybe even push us to the left a little bit, which is showing puts are getting rich a little bit versus calls, right? I want to see this overbought condition wear off. And if options prices show me that, then I'll feel a lot better about saying, okay, this makes sense, right? Now it's time to kind of get back in. So it's like, let Coinbase cool off, let Alibaba, let, Reddit, all these names, just let them cool off a little bit. Let that overbought condition kind of wear off. Maybe that is a news trigger that gets me some of that. Maybe it's just some OPEX kind of reconditioning. But let's just have this thing take a breather. Let these call prices cool off, and that could be the signal of, okay, maybe that's a decent area to start to buy back in.
That seems like that's always true of rallies. Like when we have time to digest and things don't get crazy and we just kind of calm down a little bit, it tends to be maybe more sustainable long term. We just go nuts.
Yeah, and that's the key point here is it's unsustainable, right? Because if you buy a Google call right now, right, or Coinbase, right, because you see Coinbase is as expensive as it's ever got. Stock's just been going absolutely bananas. Well, the price to bet on it going up higher requires you to have something. I think the implied vol is trading at 75 or 100% or something like that. So you need basically like let's just say 4 or 5% daily moves to sustain these options prices. And if you get anything less than that, then those options prices are going to crater, and that should bring dealer hedging flows that sell the stock. So that's why this stuff gets to be so important, because when people start to chase, they pay higher and higher prices, right, for these options, and they need ever increasing moves in the underlying for those options to pay off. Does that make sense?
Yeah, makes sense.
And in the put side of things right now, people are betting on no movement. So I don't need much movement if I buy a put right now to get paid, right? I need a very small 1% move. I'll start getting paid on some puts, which is nice, right? So, that's the nice thing about buying into low implied vol is that also the price to play is very cheap, which is nice for that downside. Conversely, stocks are relatively pretty rich to try to get in there. So
when you talked about Coinbase at 100 implied vol, it kind of brought me back to our video we just recorded and like how crazy the GameStop thing actually was. Because what'd you say it was 500?
Yeah, we got up in the 400 to 500%, depending on the moment that you looked, but it was all up in that area. And let me just reset. So I just looked on my other screen here. So if you look at, for example, the short dated implied vols are towards the 100 area. But if you look at like the August Coinbase calls, they're trading right now at a 67 implied vol. This is a name that's in the NASDAQ, right? This is not a small little hokey company at this point. It's been driven up quite a bit. But you need, so the current at the money call, just to put this in a little bit of a different perspective, for August, right, is priced at $34. So you need a 10% move in Coinbase from here to get paid on that call, right? And the stock's already gone from, up 10 to 20% in the last month. So could that keep happening? Maybe. Does that seem like a great bet? Not really. I mean, the great time to bet on that, I would say, was about a month ago, right? So, you can start to see that these things get crazier and crazier. And, that the GameStop was obviously one of the best scenarios of that ever, where, you could buy like a 50 strike put for like $45, which is just sort of like, why would you ever do that? As the prices just got so skewed because of a lot of positioning. But at any rate, the probability is one part. And if you ever look at like Kelly betting, right? Well, you got probability on one side of the equation, but then what does it cost you to make that bet? High probability situation, but you're paying through the nose for it. Maybe it's not worth it. So,
I just realized I didn't realize before you had multiple screens going there, but I should have, obviously you're an options guy. So I should have assumed you've got a strong multi-screen setup going.
I got to keep the brokerage platform off on the side. I got like the little ADD trading account that I just sling stuff around in. And so I keep it up over there and, I watch everything kind of move. And then I don't accidentally flash all my positions on screen as well, which is always a nice thing to avoid.
I've always wanted to do it, but I'm a value guy. And what the hell would I put on the screens? Like I would be just doing it to do it. There's no reason for me to have them.
You track them like the woman that tracks the charts. She plots them by hand still, so you track all of your positions in like
a tabbed
notebook.
I've got some paper to the side.
Once every 5 years, you got to pull your notebook off the shelf.
I take the PE ratios. I'm calculating them, by hand with my. That's the way to do it, Brent. You got to go against the grain. Everybody else is using all this AI and advanced stuff. You got to get out your paper.
And you say the same thing every single time. Value is still cheap.
Yeah, exactly. So that's probably a good note to wrap up on. I will just say again, like if you we have the other video, we just did it. If you didn't understand like how these expirations work, The other video is really good. It's the video before this on our channel. I did some sort of aggressive title like the hidden flows moving billions or something like that. So you'll see it right there. Got to get those clicks. But I would highly recommend it. Brent did an awesome job of explaining how all this works behind the scenes.
Well, thank you. I hope so. And I hope that everything I said here, I feel like I said a million things very fast. So hopefully it's all very clear. And I appreciate the opportunity to present, Jack. And it should be an exciting couple of weeks, I think.
Thank you. And thank you, everybody, for joining us. And we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Jack Forehand is a principal at Volatility Capital Management. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital.